Ladies and gentlemen, welcome. Welcome to the fourth conference on asset management for occupational pensions, organized by the Institute of Finance and Financial Regulation. IFFR, the Institute of Finance and Financial Regulation, is an international research center established under the auspices of the University of Piraeus of the Department of Banking and Financial Management, and its scope is to bridge the gap between industry and academia. To this end, IFFR produces cutting-edge research on timely topics, thanks to its unique team of academic and professional fellows. And it also serves as a think tank, and within this capacity, it regularly organizes a number of conferences and other events. As I said, this is the fourth time we are running this conference, which is well established by now. It is an international conference. Delegates from more than 250 companies each year attend this conference from more than 20 countries. And as in the previous years, this year again, we have a unique lineup of distinguished speakers, professionals, and academics. Before starting, may I thank our valuable sponsors: the platinum sponsor, Piraeus Asset Management Company; the silver sponsors, Alpha Trust, Eurobank Asset Management, NN, and Systemic; our supporters, the Hellenic Fund and Asset Management Association, the CFA Society Greece, and the University of Piraeus; our media partners, Business Daily, Capital GR, Euro Today, and Next Deal, as well as the C'est La Vie conference. I would like to thank the IFFR team. Many people have worked for this conference, and especially Mrs. Maria Giuli. And of course, I would like to thank my friend and collaborator, Mr. Theodore Economou, that you will have the chance to see him later in the conference. By the way, I forgot to introduce myself. I'm George Skiadopoulos, Director of the Institute of Finance and Financial Regulation and Professor of Finance at the University of Piraeus and at Queen Mary University of London. Before getting to our first distinguished speaker, may I kindly remind you that you can submit your questions through the platform facility. As in the previous years, we tend to have a very interactive discussion. Your questions are going to be forwarded to the speakers in the Q&A sessions, and you will have the chance to interact with them. And may I also kindly remind you to fill in the questionnaire, which is going to be distributed to you later in the conference. Your feedback, as always, is very valuable to us. So I think we can start now. We're going to have a very structured format, in the sense that we are going to have 3 sessions. In each session, speakers are going to deliver their presentations, and then a Q&A session is going to follow for each session. And at the end, we are going to have a roundtable discussion. So I think we can start with our first distinguished speaker, Professor Panos Tsakloglou, Deputy Minister for Social Insurance at the Ministry of Labour and Social Affairs. Professor Tsakloglou is also Professor of Economics at the Athens University of Economics and Business, and in the past he has held a number of important positions in policy making. Just to name a few, he has been the chairman of the Greek Government Council of Economic Affairs. He has been a member of the Eurogroup Working Group. He has been a social policy advisor to 2 former prime ministers. Panos, it's a real pleasure welcoming you to this conference once again. Thank you very much for accepting the invitation, and we're looking forward to your thoughts. Thank you.
Thank you very much for the invitation, George. Ladies and gentlemen, I suppose it is a common knowledge to you that until a few decades ago, in most developed countries, pension systems were dominated by social insurance pay-as-you-go schemes. These schemes were established when the demographic conditions were very different than those we are currently facing in our countries. With the growing demographic aging of the population, the importance of funding schemes rose rapidly. Within this framework, occupational pension funds can play a significant role. Let me turn to Greece. Until now, funded pension schemes play a rather marginal role in this country. In the years before the crisis, first pillar distributive pensions were giving very satisfactory and, alas for that matter, unsustainable rates of return and sufficiently high pensions. During the time of economic adjustment programs, pensions were cut, sometimes some of them very substantially, and the public pension system was rationalized. The need for supplementary pension income increased, but at the same time, due to decline in incomes, the ability to fund the corresponding schemes declined. This is likely to change in the coming years. In the last couple of years, there were two major changes in the Greek pension system. The first concerns the creation of the Hellenic Auxiliary Pensions Defined Contributions Fund, TECA in Greek. This is a fully funded scheme. It is part of our social insurance system, that is the first pillar of the pension system. This is likely to change this is likely to introduce an important change in the next years. It covers all new entrants in the Greek labor market since 2022, who have an obligation to participate in supplementary pension, and as of last year, those aged 35 or less who participate in the old national defined contribution system of supplementary pensions who wish to transfer to the new fund. Practically, this means that gradually TECA will cover all wages salary earners working in both private and public sector, a few groups of self-employed with compulsory supplementary pension schemes like lawyers and engineers, as well as those who will opt voluntarily to join TECA. There are several reasons that necessitated the creation of TECA. The most important is probably related to the need to differentiate the risk of our system of social insurance. Until recently, this system was almost exclusively distributive, while the population of the country was aging fast. This corresponding exposure to demographic risk is mitigated with the creation of TECA. In fact, under the current rules, the pensioners of the future, that is the young employees of today, will receive three pensions: a national pension that is funded by the budget and is exposed to fiscal risk, a so-called contributory pension that is exposed to demographic risk, and a fully funded pension from TECA that is exposed to market risk. Considering that these risks are not highly positively correlated, the overall risk of the social insurance pension is lower, in fact substantially lower, than in the previous fully pay-as-you-go scheme. The second important reason for the creation of TECA is that the new fund will create capital, part of which will be invested in the Greek economy. Currently, Greece's share of investment in GDP is rising, but is still the lowest in the European Union. According to studies carried out by independent institutions, in the steady state, TECA's assets will probably be around 50% of the country's gross domestic product. Naturally, higher, of course, not all of this, not even the majority will be invested in Greece. Naturally, higher investment is likely to translate into higher productivity, higher growth, higher wages, and finally, higher fiscal revenues, that is direct and indirect taxes, as well as social insurance contributions, thus cancelling out almost entirely the so-called transition cost to the new system. Within this framework, TECA can also contribute to the capital deepening of the Greek economy, an economy where admittedly the capital market is still rather shallow. The third reason has to do with the pensions of the younger generation. Even though the returns of funded systems tend to have higher volatility than the returns of distributive systems, international evidence shows that in the long run, the returns are substantially higher, especially in comparison to the unfunded systems of aging societies. Last but not least, the new system, which relies on the creation of personal accounts, is likely to provide strong disincentives for participating in the uninsured, undocumented labor market, one of the most important black spots of the Greek economy. The second major reform was voted recently in the Greek parliament and concerns occupational insurance. Occupational funds exist in Greece since 2003, but the development of the sector fell short of our expectations. Currently, there are 28 occupational pension funds in the country with approximately 60,000 members and assets under management a little above 300 million euros. Even including the other leg of the second pillar, that is group pension insurance schemes run by insurance companies, the total number of insured employees or self-employed in the country is just 3% of the total labor force, while assets under management are less than 1% of GDP. Definitely, this is a far cry from the European average. The growth of the second pillar can, at the same time, provide higher income to future pensioners as well as accumulate capital, part of which will be invested in the domestic economy, provided an impetus to economic growth. The reform of the occupational insurance has four pillars. The first has to do with the simplification and streamlining of the procedures for the creation of an occupational fund. Moreover, we introduce the possibility of multi-employer occupational funds irrespective of sector of activity. Until recently, such fund could be set up either at a sectoral or at a firm level. In an economy dominated by small and very small enterprises, this change is likely to provide a substantial boost for the development of the sector. The second pillar concerns measures aiming to increase the trust of the population to the function of occupational funds through the strengthening of rules related to good governance, transparency, and timely provision of information to the members of these funds. The third pillar has to do with supervision. Currently, the supervision of occupational funds is carried out by a tripartite schemes consisting of the Capital Markets Commission, the National Actuarial Authority, and the Ministry of Labour and Social Insurance. The scheme is cumbersome, bureaucratic, and possibly inefficient. From next year, the supervision of occupational funds is transferred to the Bank of Greece, which is already supervising group pension insurance schemes of the second pillar, as well as the third pillar of the pension system. Taking into account that the Bank of Greece enjoys a high reputation in the general public and has both the resources and the expertise to carry out successfully the supervisory role, we anticipate that this part of the reform will also increase the trust of the population to occupational insurance. The last and most controversial pillar of the reform is related to the tax treatment of the products of occupational funds. Unlike other countries, occupational funds in Greece provide almost exclusively lump sum payments rather than pensions. Uniquely in Greece, both insurance contributions and lump sum payments were tax-free. With the new legislation, this regime came to an end for the funds that will be accumulated from the 1st of this year onwards. The tax rates for the products of both segments of the second pillar, occupational funds and group pension insurance schemes, are equated so as to eliminate tax arbitrage between the two and are set at low, favorable for their growth levels that decline with the time of participation in second pillar schemes. In other words, we provide incentives for people to remain longer in the second pillar of our pension system. Moreover, the taxation of the second pillar pensions is set at half the level of taxation of lump sum payments, so that pensioners, especially those with substantial savings, are encouraged to receive a pension rather than lump sum payment, thus boosting their income throughout their retirement period. Even though taxation was introduced for the products of occupational funds, the new tax regime is one of the most favorable in Europe. We should not forget that in many countries, the only tax advantage enjoyed by second pillar pensioners is the tax deferral, that is the transfer of taxable income from the period of the life cycle where income and tax rates are high, that is the working life, to the period where they are low, that is retirement. We should also not forget that any tax break has a fiscal cost that should be duly justified to the taxpayer. The reason that we opt to provide a tax break to the persons insured in the second pillar of the pension system has to do with the very low levels of savings in Greece. We should not forget that the tax rate of these products are substantially lower than the marginal tax rates of the corresponding insurees. Now, such savings that I mentioned that are quite low in Greece are not adequate to finance the investment that is needed in order to achieve the higher growth rates that are required in order for Greece to converge to the European Union average. All in all, we believe that the reforms we enacted, in combination with the very substantial cuts we implemented, as those we plan to implement in social insurance contribution, will boost funded pension savings in Greece and will give you plenty of material to study in the coming years. Thank you very much for your attention, and I wish you a very successful conference and a fruitful exchange of views. George, I think you are muted.
Thank you, Panos. Thank you very much for opening this conference.